Yes, the next important ratios that we'll be doing is gearing and financial risk. Gearing, as we already studied, is the fixed financial burden that the organization has. So if the organization has debt versus equity, in case of debt financing, the interest is a charge against profit. That means irrespective of the organization makes profits or loss, it has to pay the interest to the liability holder. Let's assume the debt has been taken from a bank. In case the organization makes a loss, the bank will not agree to not get interest on account of loss being incurred by the organization, isn't it? On the other hand, equity holders are owners. In case of a loss, equity holders will not get dividends if the retained earnings are not positive, right? So the equity holders get profits only when there are positive retained earnings in the form of dividends. Otherwise, they are not dividends, right? So there is fixed financial burden with respect to the debt portion. That is why debt is very important. First such ratio is debt equity ratio, which is debt upon equity. Debt stands for the long term debt, and equity stands for long term equity. That means what is the proportion of debt with respect to equity? If this ratio is more, that means if this ratio is increasing, that means the equity as proportion of debt is getting decreased to safeguard the debt holders from any losses, or to provide safety margin to the debt holders. Let's take an example again. We discussed in the first video of the ratios. Then there are two banks, bank 1 and 2. Both are having assets which are loans extended to people of 100 each. But the liabilities here in bank 2 is equity 90 and debt 10. Whereas in bank 1, debt is 90 and equity is 10. Let's assume that NPAs are 30%, meaning thereby some of the assets or the loan takers are not giving the interest or principal obligations on time, due to which the assets now are becoming non-performing assets, right? That means the assets are worth 70. Now to the 70 entirely will go to debt holders. They will be, since the book value was 90, they will be suffering a loss of 20, and equity holders will get 0. Book value was 10, they will be suffering a loss of 10, and the entire loss is 30. Total cash flows that they will be getting is 70. Whereas in this company, sorry, in this particular bank, the entire 70, out of the entire 70, 10 will be going to debt holders and they will be sacrificing a 0 loss, whereas equity holders will be having only 60 and they will be having a loss of 30. So loss total is 30, whereas total cash flows will be 70. So in both the cases, the cash flows are 70, but here in the first bank, debt holders are actually sacrificing the loss of 20. Why? Because there was less of equity to absorb the losses, right? To provide the safety margin to the debt holders. Therefore, for any potential debt that you need to take, the organization needs to take, or to attract potential investors, the organization must have a lower debt equity ratio so that debt holders are assured that there is enough equity to absorb the losses, or to enough equity to provide the safety margin to them, right? Similarly, debt to capital employed is another ratio. This is similar to debt to equity. Agar if debt to equity is 1 to 1, definitely then debt to capital employed will be 1 by 2, because capital employed is nothing but debt plus equity, long term debt plus equity, right? So these two are same, but the only difference is whatever ratio that you use, only that ratio should be used on a consistent basis, so that you can analyze the situation very clearly and correctly, right? The next ratio is interest cover ratio. This is really important and very interesting. This says that PBIT upon interest. See, interest is paid from which profitability level? Profit before interest and taxes. This says that what is the interest cover? How much are the profits to cover the interest payments? Let's assume that our interest payments are 10 and profit before interest and taxes are 30. That means we are having 3 times the profits to cover the interest. That means there is a less likelihood that the organization will be unable to meet its interest obligations on time. So higher the interest cover, the better it is. If the interest cover is less than 10, that means the profits are not even enough to repay your interest obligations, right? And that is a trap that the organization will be in if the interest cover is less than 1, right? Another type of ratios are investment ratios. These are for shareholders per se. Shareholders are the equity owners. First such ratio is dividend cover. Similar to interest cover, dividends are paid from which profits? Net profit before ordinary dividends, right? More the ratio, better it is, because a lot of dividends can be covered. What dividends you need to take? The average dividends that are paid, right? Or if nothing is given, then you can take the last year dividends or so on. Or you can analyze the trend in this, right? Next is dividend yield. Yield is the return that you get. See, you are getting dividends, but you are paying what? To acquire the share from which you are getting dividends, you pay the market price. So, what is the rate of return on the price that you have paid for a share in the form of dividend is dividend yield. More it is, the better it is, because you are realizing more of the cash invested right now in the form of dividends. Earnings per share is the total earnings. Since it is earnings per share, it will be divided by number of shareholders. That is it, or number of shares. Not number of shareholders, but number of shares. Because a shareholder can have a lot of shares, right? The last is PE ratio. This is, as the name suggests, price earning ratio. Market price per share divided by earning per share is the formula for it. It says that how the share is valued in the market with respect to the industry or the competitors. If let's say industry's average is 5, but your PE ratio, your company's PE ratio is 4, that means the company is undervalued, maybe because of its fundamental characteristics which are not good, or maybe because the fundamentals are maybe because the fundamentals are good, but people are unable to see it or capture it, right? So there can be two factors relating to this. But if the PE ratio is great for a particular company, that means people are actually forecasting that the company has a huge growth prospects, right? So higher the PE ratio, higher the overvaluation, but people expects that the growth prospects are huge for this particular company. But this is always should be taken into consideration that you need to analyze PE ratio with respect to the industry or with respect to the competitors. PE ratio on a standalone basis will not be a good way to analyze the ratio.